E&J Capital. Today's video will be about Sharpe Ratio. Sharpe Ratio is a formula used to measure risk in a portfolio. The higher the Sharpe Ratio, that means you took on less risk to make a better return. You'll see Sharpe Ratio if, let's say, you work at a company and they allow you to choose between mutual funds for your 401k. You find the one with the best Sharpe Ratio with the least expense ratio, and it's usually the best fit. They took on less risk to get a better reward compared to its competitors. So let's just look on one of the more famous ones is Vanguard ETFs, mutual funds, all that. Vanguard S&P 500 ETF, it's under risk. This is Yahoo Finance. Sharpe Ratio 0.58 compared to category average of 0.94. So this isn't the best example of a good Sharpe Ratio. Let's go back to Vanguard. Let's do VGT. Vanguard Information Technology Index, go under risk. This one's better. Sharpe Ratio 1.23 compared to 0.86. So this is a better investment just based on Sharpe Ratio. And you notice the Sharpe Ratio, and they have Trainer Ratio. Trainer Ratio is similar to Sharpe Ratio formula. The expected return on the portfolio minus the risk-free rate divided by, now Sharpe Ratio is divided by standard deviation. With Trainer Ratio, they don't use standard deviation, they use beta. When we talked about beta, we talked about standard deviation in another video, but we're not talking about Trainer Ratio, so this doesn't apply to us. The actual formula, like I said, is the expected return on the portfolio minus the risk-free rate divided by the standard deviation. Standard deviation is, you'll see it on the normal distribution, the curve, and let me just get a picture right here. You see something like this. The zero is the mean, the average, and let's say these were stock prices and we plotted in like the past year stock prices. We would find the average, then we would find what's closest to the average, and that would be within one standard deviation. So that would mean that majority of the time a stock price will end in one standard deviation to the mean. But let's say it's 10 points and the mean was 100, that would mean majority of the time it will be between $90 and $110. 68% of the time it will be. But that's just an example. Let's pretend, right? These are three different stocks, Johnson & Johnson, Goldman Sachs, and Apple. And I actually used this website, onestock1.com, and I just plotted in the past 10 years of their returns. These are their returns each year, and we're going to find the Sharpe Ratio. We also need to know what this is. This is the risk-free rate. Risk-free rate is where you can put your money that has the lowest chance of defaulting, lowest chance of losing money. What's the safest investment? The safest investment is bonds from the government. I said before, if the government doesn't pay you back, you got bigger problems on your hand.
T-bills or T-bonds? T-bills, T-bonds, U.S. backed bonds. They'll pay you back.
If it was another country, like if it was like Argentina, they wouldn't be the safest. Treasury bill rates, treasury.gov, and current month it's, wow, 0.09. It's trash. It's low because the Fed cut interest rates down to zero, so this will get affected as well. But last year it must have been like 2%. Yeah, 2.36. Like I said, this is just an example. So I can use 2%, I can use the 0.09. I'll just say 1%. Risk-free, we'll say 1%. So we found our risk-free rate. We need to find the expected return and the standard deviation. There's a few ways you can find the expected return. We're going to simplify it right here. We're just going to find the average, and we're going to use that. But give yourself multiple scenarios, right? Because the economy just doesn't always go up. Even though it seems that stocks only go up.
You know what we say at DDGG Global? Stocks only go up. And anytime you think they're going down, they're going back up.
The economy can go up, have a booming economy where everybody's paying for stocks, everybody's spending money, everybody has a job. You can have an average economy where it's just the average, or you can have a weak economy where, people are not spending, people are not going to spend money on stocks, nobody has jobs. So you could pick between the three and kind of like average it out. But we're going to simplify it, and we're just going to find the average, and we're going to use the average annual return. So this was the actual return. So what we'll do, we'll just, let's say you get the sum of it and you get the average. You get 430, and then you divide by 10. 43.1. That's crazy. Load up on Apple when there's a stock split, because Apple's a stud. Now you want to take the average return minus the risk-free rate. So over here you could say it would be the excess, the what's left after you take out the risk-free rate. Simple enough, would be equal to minus this, and you just carry it down. So this is the excess return. What your return is after you take out the risk-free rate, the rate you could have got if you just put it in T-bills, even though that's still high. So we're going to take these average returns out, and we're going to do it with the sum of this one, because this one is factoring in taking out the risk-free rate. You have your average return, you have your risk-free rate, which we already factored in the average return. Now you want to find standard deviation. So you want to find the standard deviation of each of these. No, not that. This. Standard deviation of Johnson & Johnson was 0.11175. To get the Sharpe ratio, you just take the return divided by the standard deviation. And remember, since we used the average return after we took out the risk-free rate already. Sharpe ratio for Johnson & Johnson, if that was its own portfolio, is 0.78. Goldman Sachs was 0.41, and Apple was 0.93. Based on this, Apple was your best investment. And I could have told you that without even looking at it, because those returns are crazy. And they only had 2 negative months. Not 2 negative months, 2 negative years. They had one bad year in 2015 where it went down 4%, and one bad year in 2018 when it went down 6.79%. And if you remember, in early 2019, they rebounded very quickly. Nowadays, the stocks rebound. They don't let you stay down for more than a few months. So buy dips, hold your positions, wait out the storm, because it's going to come back, especially with Apple. So Sharpe ratio, expected return minus risk-free rate divided by standard deviation. The higher the Sharpe ratio, the better. It means you took on less risk to make a better return. And out of these three different portfolios, if they were all 100% weighted and they were on their own separate portfolios, Apple would have been your best bet. E&J Cap.